Welcome to This Week in Money. I'm Jim Goddard. Today, American Manganese CEO Larry Reaugh outlines his concerns about Canada's flagging junior markets and suggests ways their problems could be solved. Mike Swanson from WallStreetWindow.com warns the equity markets are in a volatile state that could threaten your investments. We talk to Larry Reaugh right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Larry Reaugh, CEO of American Manganese. Welcome to This Week in Money, Larry.
Well, thanks. I'm glad to be a guest on your show.
Today's show will look at market collapse and the Uptick rule. Perhaps before we get into particulars, explain what the Uptick rule is for folks who may be unfamiliar with its concept. Well,
the Uptick rule, I'll just give you a little history on it. The Uptick rule was established by the United States SEC in the Securities Exchange Act of 1934 as Rule 10A-1 and implemented in 1938. Now, to get into the rule was put into during the Great Depression to restore confidence and stability to the stock market. The Uptick rule had the desired positive effect on the market and was later adopted by the Canadian Exchange. The rule basically stated that short sales, and that is selling stock in which you had no ownership, must be made on an uptick from the last trade. For example, if you're trading at $1, you wouldn't be able to short it unless it was $1.01. And the amount of stock you shorted had to be pre-borrowed from investors who owned the shares. So it was basically a rule that kept predatory trading from driving stocks down. Before, there was no rule. And unfortunately, after 69 years, the SEC repealed the rule on July the 6th of 2007 in the U.S., whereby traders could now sell shares and stocks at the bid prices, and they didn't have a requirement to borrow. And that saw a softening market in 2007, and I'm certain that it lit a fire under the crash that New York underwent and subsequently affected all the markets in 2008.
What was the reason behind removing the Uptick rule?
Well, I couldn't answer that for you. I can speculate that it was being lobbied for by self-interest groups that knew that there was a lot of money to be made on the short side if the Uptick rule didn't exist. And I'm not talking small amounts of money. I mean, I'm talking in the tens or hundreds of billions of dollars. Basically, it's a conflicted situation where the ordinary investor is not even aware that it doesn't exist anymore. The ordinary investor wasn't even aware that it existed before and protected him. And now there's no rule, he has no protection, and he sees the market thundering down. To give you an example, in 2008, more millionaires and multimillionaires and billionaires were made on the predator side of the market, being the short side. And take, for example, Bear Stearns, which dropped from $61.60 to $284 in 6 days on unprecedented volume equal to 4.2 times its total float. That means for all the shares issued, it actually four times that were sold into the market, which when you don't have an Uptick rule can happen. And the stock went down to $2.84. We no longer see it around. And Lehman Brothers, these are old names that we saw for decades. Took a similar dive, going from 16.25 to 15 cents a share in 5 trading days on a volume 3 times its total float. Fannie Mae, which was trading at $49 in 2007, hit 49 cents, as did Freddie Mac. You have no protection. And actually, in order to protect the financial instruments, the SEC, imposed a rule that you couldn't short financials any longer. Everything else was fair game, but no more financials.
Do you think investor confidence would disappear if they became aware of the devastation that can be caused by the removal of the Uptick rule?
Well, let's look look at our market, the venture exchange, which is a thinly traded market, and as you know, there's 1,000 plus companies in trouble on that market. Nobody can raise money. There's a very few companies that are still being able to raise money at much lower prices than they would ordinarily have. And but the investor doesn't know why he can't make money, and they've left the market. It's not that they're thinking about leaving it. They're not buyers in the market anymore. And but they don't really understand the reason why the markets are going down. They read the headlines, which are commodities are crashing. We've been reading that for 4 or 5 years. And I'm talking basically about the resource industry that I'm in. And yet, commodities didn't crash. They've basically just started to tip over the edge here in the last few weeks. And but that's been the emphasis of the reporting of all the talking heads out there that talk about what's going on in the resource industry. And so the investor's bewildered. He just doesn't understand. And of course, the big thing is, what do we need mines for? Younger generations don't realize that the car they're driving, that the computer they have, that the cell phone they have, all have some sort of metal in them, right? And they just don't see the need for mines, which are, of course, the other side of the coin is we get lots of press on anything that pollutes and very little on anything that we do that's good. So the investor's sitting bewildered, and he's not aware that there is an uptick rule. If he was aware there was an uptick rule, and he saw it, okay, this is a cause and this is an effect. And I'm not saying it's a total cause, certainly high-frequency trading has something to do with it. But the uptick rule, just in the explanation I gave you, shows you that in the reality that short sellers can force the direction of the company because they have unlimited selling, and they can knock out the bids, discourage investors, and the stocks have nowhere to go but down. That's just the nature of the beast. And so when we get into what if the investor knew about this, would he leave the market? Well, he's already left. But if he was aware that there was a uptick rule, that will probably be reinstated, because otherwise we won't have a venture market. The Canadian markets will, and I should mention someplace along the line here just exactly where I'm going on this, because I haven't finished discussing the uptick rule itself. But I think that it would be a very positive thing if the investor was aware that an uptick rule is discouraging or taking away profits that should have belonged to him, and could wait for better times.
Are there any benefits to repealing the uptick rule, such as naked shorting, etc.?
Okay, I'm going to back up a little bit on that, and I'm going to talk about the U.S. uptick rule, which I told you about in 2008. And certainly there was a lot of lobbying that went on by investors and politicians to reinstate the rule because they saw what it was doing to the market. And in 2010, a partial rule was reinstated. Since that time, the Dow has actually moved from 10,000 up to 17,000. And then in 2011, it was proposed that the uptick rule be removed on the Canadian exchanges, and that was approved, and it was actually didn't come into effect till 2012. But now we have no uptick rule here in Canada, and so where the U.S. was back in 2007, 2008, 2009, and it's not a good thing.
How much pressure is there to bring back an uptick rule or a modified one in Canada?
That I'm not sure. I know there's some movement afoot that the uptick rule should be brought back, and I think that it will be. Certainly, it has a very negative effect on everything that everybody's doing. A lot of jobs have been lost. Venture exchange, we've lost the title as the venture capital of the world. These sorts of things have happened just almost overnight. And as you know, I used to write the fundamentals of the commodity market, and I think you've actually interviewed me on that. But I stopped writing that after January of 2011 because fundamentals weren't working anymore. And it's only it's not the fundamentals so much now. It is that it's the expectations of, or the perception of the market. The perception of the market is that commodities over and done with. Mining is going to come to an end, and that you shouldn't own any of those stocks. And, that's a direct result from having a negative impact on the companies that have had press releases that have stated good, positive results and have gone backwards. Investors pile in on a good feasibility study, on a new discovery, and shortly thereafter they're looking at losses. And because that's a natural target for predators, they need the volume, they need the buying in order to sell, and that's where they move to. And as I said before, that's the nature of that game, and that's exactly how they play the market, and you can't blame them for it.
We'll have more on the Uptick rule when we return on This Week in Money with Larry Reaugh.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. We're speaking to Larry Reaugh, CEO of American Manganese. We're discussing the Uptick rule, or the lack of one, in the Canadian markets. Is there any reason why the Uptick rule shouldn't be there?
There's no reason why that the Uptick rule shouldn't be there. It should be there. We've learned from experience after the market crash in 1929 and the Great Depression of the 30s that the Uptick rule helped to stabilize markets. And, that function it's been carrying out for, 69 years up to the time it was appealed in the U.S. and now it's back reinstated. But we can't build companies if you're not able to raise money, if you don't have investors that are willing to put money into the company, if you don't have funds that can't see a profit, can't see an exit for their clients' monies or their investors' monies, they're not going to put them into a Canadian deal. So you got to have the Uptick rule.
Now, somebody mentioned the term naked short selling. Is that a factor? And
well,
what is
this
it?
term has been bandied around for the last 15 years, since about the mid-'90s, and I do think that it was going on, which means that nobody was borrowing stock to short. But now, without an Uptick rule and no requirement to borrow the stock, it's still naked shorting, but it's legal.
Now, countries like Germany have banned short selling. Their reasoning being a stock market is there to raise money, not lose it. Do they have the right attitude?
They have exactly the right attitude. That's how you build the country. You start by building the companies that would support jobs, would support spending, manufacturing, all these things within your country, or mining for that matter, and all the things within your country that bring benefits to the country itself. But shorting brings benefits to nobody but the predator. They get rewarded for actually destroying a company, and they get all the money at the end of the day.
Australia is a resource-based economy with an Uptick rule. Is there a difference between the charts of the Canadian and the Australian markets?
Well, if you looked at the Australian chart, you'd see that it pretty much mirrors the Dow Jones, which has been steadily rising since 2010 for the past 5 years. And so has the Australian exchange, which we could compare, to our Toronto Stock Exchange or our Venture Exchange, because, as you know, the Australian market is heavily resource-based, but it's still going up, or it was the last time I checked.
And a currency trader we talked to said the U.S. dollar is about to flutter and start to fall, and he said the Australian and Canadian currencies actually are going to be the hot ones again.
Well, I would agree with that. That it's kind of like putting a rock in a glass, and the rock represents all the other currencies, and the water represents the U.S. currency. And when the other currencies go down, the U.S. one goes up. When the U.S. one goes down, the other currencies go up. And certainly a strong dollar right now is hurting a lot of industry. It's beneficial to some. I mean, certainly if you're producing copper in Australia and getting paid in U.S. dollars, it's got to be a benefit there. In Canada, if you're producing metals and you're getting a 25% differential, that's 25% right on the top on your margin that you're making from selling those metals, because you get paid in U.S. dollars. You convert them back to Canadian, you got more money for your product.
Could the lack of an Uptick rule in Canada cause companies to list in jurisdictions that have an Uptick rule?
I think that's going to be, if anybody's going to survive, that's going to have to be the ultimate destination, yes.
What's that going to do to the Toronto market?
Well, the Toronto market itself has really not gone anywhere. It hasn't gone crashing down. It hasn't gone skyrocketing up. From the time that I'm just trying to remember back now, but I don't think it's very far off of where it was when the U.S. reinstated their rule. It used to be that the Toronto market was at 2,000 or 3,000 points above the Dow, and now we're 3,000 points below, or 2,500 points below. So that does to tell you there hasn't been a solid good effect on it. But I think that the powers to be I understand, are looking at this. And you don't need a lot of studies to realize that something's affected the market in the last few years, and maybe it just happens to be the uptick rule.
Of course, you've suggested, too, the over-regulation in the Canadian markets, and the regulations seem to increase every day. Also, another factor for people not wanting to invest money there, because so much of the investment fund goes to paying off regulators, auditors, and lawyers, that not enough of it is going, at least on the venture exchange, into exploration, trying to develop new product.
Well, that is true. We have a lot of regulation here, and certainly, we should have a very safe exchange, except that, I think that not having an uptick rule negates everything that's being done on the regulation side. The fact of the matter is that it costs you so much money just to keep your company listed and have your corporate governance in good standing each year with your financials and your listing fees and all of these things, that there's nothing left to in these markets where it's very difficult to find an investor to raise money with, just to keep the company alive, and that's what we have to do. I mean, markets come, markets go, and I'm sure that the market will come back around again, but it won't come back around if we don't have an uptick rule.
There's a prediction that the markets are about to have a major fall. Some of the recent numbers we've seen might indicate an early drop. Some people were saying it would happen later in the spring. But whatever happens, is that your opinion, too, that the major markets are about to have a drop?
I think you're seeing it. I think you're seeing a drop right now. And I'm hoping that this is going to be a spike like we saw in 2008, but not nearly as drastic, and that the markets will rebound from there. And that would be a good time, of course, to reinstate the uptick rule, because then it would allow the Canadian companies to rebound along with everybody else.
And to hope for more quantitative easing, I think, is a false hope. I mean, how can you go any lower with interest rates? They're already zero for the banks in the U.S. and 0.75% in Canada.
Well, the big talk out there right now is the raising of the interest rate, and that's what's clobbering the commodities. And don't give me I can't understand the rationale of that and why gold should be going down. There's absolutely no rationale. We have to believe that the large amount pools of money are the ones that move the markets, and it really doesn't depend on supply and demand factors. It doesn't depend on wars all over the world. It doesn't depend on potential currency collapses all over the world, and including at home. None of these things react. It's just basically it reacts, okay, the U.S. dollar's going up, so copper should go down, and or gold should go down, and we're seeing that. Does it make any sense? Not to me. I've been around the game for a long time, and none of the old tried and true things that we used to look into and chart see where the markets were going work anymore.
The lack of an uptick rule allowing things like naked shorting. What is naked shorting, and is that an even playing field for the average investor?
Well, it's not for the average investor. An investor, just the word alone says they invest, right? They invest in the company, right? They invest in the growth of the company. Naked shorting invests in the demise of the company or the falling of the company. Naked shorting is just basically not having to borrow stock. And, of course, with no uptick rule, I think what I've read is that in certain cases, you have to borrow the stock, but I don't see a short position on any of these companies that are obviously getting shorted. And so, the borrowing of the stock is gone. So it's naked shorting. That's what naked shorting is all about, where you don't borrow the stock.
Does that result in predatory markets?
Of course it does. And, the power is all in the hands of the predator. Like I say, they can determine, singly or collectively, on the direction that a company is going. Let's say, this company has a bad quarter, or it has a good quarter. And, but in the meantime, the predators are watching it, and they see buying come into it. So they short it. They start selling stock they don't own. They sell stock that doesn't exist. And the investors get overwhelmed, and when they get overwhelmed, the stock drops. And at some point, after the drop in the stock, the investor today becomes the seller tomorrow. And he sells his position out, and who picks it up but the predatory trader. And when he picks up that position, he pockets all the money that's made. In the meantime, the investor loses money. And he sees this happen to him time over time, time after time after time. And so eventually he throws in the towel and says, I can't do this anymore. Maybe I should be investing in mutual funds. Maybe I should just keep my money in the bank. Maybe I should buy bonds. There's no reward, and there's no, basically the venture exchange is a high-risk market. But, that's where you make these, 12 times, 20 times your money, is if you happen to catch the right boat. But you don't have that ability anymore. If you do catch the right boat, you might make 3 or 4 times your money. But you'd have to risk a lot of money to make a lot of money. But before, you didn't have to risk that much money to make a lot of money. And that's all taken away now.
Larry, what's your overall message to regulators and the government about uptick rules and short trading?
Well, I don't think that short trading, although, they will claim that it's required to help make a market so stocks don't run away. We haven't seen a runaway stock in 5 years, but the truth of the matter is that I think that we have to have an uptick rule. It worked for, our great-grandfathers and our great-great-grandfathers, and they imposed it to have an orderly market. Worked for about almost 70 years, and now all of a sudden it's gone, and we're seeing the results of it. We saw what happened in the U.S. That is just historical stuff. You can go to the SEC, the uptick rule, SEC, Google all this stuff. You'll find lots of stuff that's written on the devastation that was caused. They claim that millions of people lost their life savings in 2008. And, my message is that we need jobs in this country. We need things to progress. And in order to do that, we have to have orderly markets where new ideas can get financed. New properties can get financed. Doesn't necessarily mean that every company is going to find something of value. We know that doesn't work. But there are companies out there that can find value, bring value back to the country, create jobs, and that's what it's all about. It's all about creating jobs and rewarding the investor, not the predator.
Larry, is there a website people can go to?
Well, like I say, you can Google websites on the SEC uptick rule or the IROC uptick rule for the Canadian side, and you can start gathering information from there. And I've gathered a lot of information off of those. I mean, I couldn't understand why the markets weren't reacting the way they should have. All of a sudden, there was definitely an anomaly out there that had changed. And then I find that there's no longer an uptick rule, and the dime dropped, and it all fell into place. But I had to go searching for that, and I would say that it would probably do you well if you're looking at investing to actually go to those sites and see, historically what's happened in the U.S., and then you can conjure up what you think is happening here in Canada now. I can't claim that the uptick rule is basically harmed the market because I don't have statistics to prove that. All I have is that it didn't work in the U.S., and why should it work in Canada, and why are we undergoing such market corrections here?
Larry, thanks a lot for speaking to This Week in Money.
Well, thank you.
My guest has been Larry Reaugh, CEO of American Manganese. After the break, Mike Swanson from WallStreetWindow.com on This Week in Money.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to This Week in Money, Mike.
Oh, thanks for having me. It's great to talk with you.
Well, there you are on Wall Street. And is this the start of the meltdown that they've been telling us for the last 2 years is going to happen?
Well, I do think I do have a lot of concerns about the stock market, and the Nasdaq went to 5,000 the other week and was above that level for a few hours, and this has happened as for 6 years into this bull market, and there's been no bull market since the 1930s that's gone on longer than 6 years, and the market is overvalued on a cyclically adjusted PE ratio level. It's at 27.3, which has only been higher than that in 1999 and 1929. And what really concerns me with the stock market is we've seen fewer and fewer stocks participate in the rallies. That really started in July, but it's gotten worse and worse. And every week it seems like there's a big cap popular stock that falls and gets basically broken on the charts. Last October it was IBM. Last month it was Microsoft that's done that. Intel did it. This week Alcoa did it. So that stocks are basically on an individual basis blowing up, but the market averages are acting stronger because a few stocks in that is helping them. So Apple, for example, helped drive the Nasdaq higher last month and first couple of days of this month. So I do think people should be more cautious, and I actually think we're in a very potentially dangerous time in the market for the next few months, because if this is a top that's going to lead to a bear market that we've seen, I mean, we're in a correction. I think that's clear. We saw the Dow fall 300 points the other day, and then yesterday rally, but it's given up the losses very quickly. And that's what you tend to see in corrections. Or, overall in a week the market goes down, and then you get some rally during that doesn't amount to anything and just fades. And corrections end in panic, washouts, a temporary bounce of fear. And we don't really have any signs of that yet. So even if we're in a bull market, still, I would expect the market to continue lower until we do see signs of some panic selling, and probably take lower prices from here to make that happen. I would think we'd probably at least go to the lows of January. Now, if we're in a bear market, we'll fall farther than that before the correction comes to an end, and it could fall for months instead of weeks. And there's really no way to know for sure which is the case. So I think people should just step aside as far as doing any new buying and just let this play out, and we'll see how far the market drops. And if people are fully invested, I would even suggest that they lighten up on some of their positions and raise some cash reserves in order to use later on when the market's at a lower level.
Are there any particular areas that are going to be hit or are being hit right now, or is it just all over the map?
It's really all over the map, and frankly, that's something that has me concerned about it and surprised. In September, when the market fell into October, just about everything fell then, too. If you can recall, commodities and gold fell really hard in October, but oil did too. That's when oil started its big 50% decline. And the decline really picked up in October. So everything kind of fell for about a month in September and October. And so far, since the start of this month, the same thing seems to be happening again. In fact, the CRB index, the Commodity Research Bureau index, which tracks a basket of commodities, made a new 52-week low today. Gold and silver have been a little weak so far this month, which frankly has surprised me a little bit, but it's what it is. And all world markets are pulling back too. And one of the things that's really interesting is that the TLT ETF, which tracks the 20-year Treasury bond, it's not even acting very positive in the face of the market pulling back. Usually that creates the opposite to the market. It's not really doing a good job of that right now. In fact, so the only thing at the moment that's going up is the U.S. dollar. And the only time I remember a market situation like that where everything is kind of weak, but the U.S. dollar, was in 2008. Now, I'm not saying the market's going to crash or we're having some big crisis like 2008, but the action right now isn't very fun to be looking at.
Once the U.S. currency peaks, are there other currencies that look strong enough to gain some position there?
Yeah, and I do think that's where people should look and be patient for an opportunity, because even though the dollar has gone up the past couple of weeks, really the past year, at some point the dollar is going to stop going up, and I would be looking for stuff like the Canadian dollar to rebound. I mean, it's gone down quite a bit in the past couple months. And I'm also looking for a bottom in commodities, and gold and silver should bottom first and lead the way or turn up first. They haven't gone through their lows of last year, which is a positive. So at some point I do look for these commodities and gold and silver and some currencies to turn up, even if the market continues lower. In fact, if the stock market continues lower and these things start to go up anyway, that would make for a really, really positive divergence and bullish signal to buy into.
Of course, right now people would tell us that Canada and Australia, two places that rely on commodities, how could they be in a position to rebound if the U.S. dollar goes down?
Well, if the U.S. dollar goes down, commodities will probably bottom around the same time, which should be a positive for Australia and Canada. Even oil prices, I'm not really looking for oil prices to explode higher or go into a new bull market myself anytime soon. In fact, there are people saying that or calls for that in January, and I was disagreeing and saying I thought it'd be over a year before oil really goes up. But I think oil can bottom, in the next couple months if we see oil prices go lower. And all oil needs to do is bottom out to help the economies of oil-producing countries.
Now, I've heard that they are still producing 2 million barrels of oil a day more than the world consumes. Right now, they're storing it in tanks on seaborne tankers. But they're filling up, and by May, they're going to be full. Then what happens with the extra 200 million barrels of oil?
Well, I think that's why we shouldn't be bullish on oil yet and be willing to wait and let the supply hit the market. In fact, almost always in a commodity, the bottoms actually come when supply hits the market, and then you see stories of oversupply and not enough demand and all this kind of stuff. Usually the bottoms coincide with that kind of stuff news going on. So if we know that's coming, then the thing to do is wait and then let that supply hit the market and then try to pick out places for bottoms in. And
does that mean then you should take a look at oil stocks and see how far down they go, and when they seem to hit the bottom, take a look at them again?
Yeah, that would be the thing to do. Don't look at them now, but wait. Yeah, in fact, if you guys looking at a chart of the XLE ETF this afternoon, which tracks oil stocks, and it's right back on the low right now. And just at the beginning of the year, it had a tremendous rebound, close to 20%, and that rally's pooped out. So, people like to see these big rallies and buy into them, and a lot of people got fooled right there. In fact, on Ameritrade, the brokerage house Ameritrade, they release every month details on what are the most popular stocks people are buying and what are the ones they're selling. And in January, the individual traders on Ameritrade as a whole were flocking into oil stocks right at the top. And, that's the tricky thing. When you see a negative market, it's so easy to see a rally and think it's going to go up and then get trapped. And it's really time to be more cautious and raise cash reserves and just be willing to see what happens in the next couple of months with the stock market. Because, look, it's been 6 years ago to this month that the stock market bottomed in the last market, and we've been going up ever since. But do you want to bet on a 7-year that we're going to get an extra year, or that the stock market is going to somehow get as overvalued as it did in 1999 or 1929? Things only happened twice in the past 100 some years, over 100 years. People just got to be really cautious now. And it's tough because the market's so volatile. Yeah, it was up 300 points, the Dow, yesterday, and it's so easy to see that, want to be in, to want to buy something, and then today it poops out. In the end, you just got to be patient. If you could turn back the clock to 2007 in that summer, and were given a chance to reduce positions or get a cash, and then just step aside for 2 years, you could have made a fortune, and everyone could have. And now I think we have a similar opportunity. Doesn't mean the banking system's going to crash, but bear markets come, and it's just a part of the stock market.
And people are pushed there because if you put money in a savings account, you don't make any money.
Well, that's the real crime now. Is in 2000, in December 2000, I went to my mom, And I got her to cash out of her brokerage accounts and put the money in municipal bonds and corporate bonds that were yielding 5-6%. In 2007, there's still a chance for people to do that, but not today. And that's why this is even a more treacherous market environment than probably we've ever seen, because everyone is fully invested. They're not willing to get out just because of that, because they don't know what to do with their money. They see no alternative, and they're told there is none. And at the moment, that might be the case, in the sense that their only choice is cash or the stock market. And that's not a good choice, but that's not a permanent situation. And at some point, gold's going to go into a new bull market and other things will bottom out. But it's, to be willing to wait or reduce positions is just so hard for people to do that.
We're speaking to Mike Swanson from WallStreetWindow.com. Mike, if people are being advised to perhaps sell and take out cash, are there opportunities in other stock markets besides in North America?
Well, there are, but there's markets overseas that we've talked about before that are very cheaply valued. The Russian stock market, for example, while the U.S. stock market has a cyclically adjusted P of 27, its cyclically adjusted P is around 4. And if you look at a chart of RSX, which is an ETF that tracks Russia, you'll see that it basically crashed in November and December and had a great recovery rally and is pulling back now, along with everything else. But that's a market that I do think provides a good opportunity to invest in cheaply and do well over the next couple of years. However, over the next couple of weeks or a month or two, it could get under pressure if the U.S. stock market continues to decline. So I think there are opportunities out there. I just think at the moment it's probably best just to wait a month and just see where things stand in.
The BRIC countries, Brazil, Russia, India, China, made a big noise before the new year about starting their own international monetary fund to help out their friends and people they thought needed a break. How are they doing with that?
Well, it hasn't really been in the news that much. We heard the story about that happening, but I think it's really a slow developing story that will play out over decades and won't really have an immediate effect on what happens this year or even next year. But it's the long term. I mean, the geopolitical trends, I think, are clear that the United States is the world's superpower right now. It has been since World War II. The sole superpower, really, since World War II, even though the Soviet Union was considered to be the competitor. But we all know, the Chinese economy has now surpassed the size of the United States economy. Did that last year. We see what's happening with Russia and the United States becoming angry at each other. In India and Brazil, the economies there are growing fast, and the countries there are nothing like they were 40, 50 years ago. It's not to say that the United States is finished or it's, ancient Rome or something, but I definitely think it is the case that by the end of our lifetimes that China, Russia, the BRIC countries will be superpowers essentially too, and the U.S. won't be the sole power in the world. It'll be a more competitive system. And what I think is going on now is we're early in that evolution. The mess in the financial market since 2000 is a symptom of these changes taking place, but the first part of it is what you're mentioning, and that's these countries working together to become competitors together with the United States. But in time, they'll split apart too, because they'll be competing with each other. So I don't think, they're going to gang up and defeat us or do something. It's just a part of a long trend.
And what about the impact of driverless vehicles? I read an article where 3.5 million driving jobs could disappear in the U.S. over the next 5 years.
Well, someone mentioned to me driverless vehicles a few hours ago, and I don't know, the whole idea scares me. I don't want to get in a vehicle like that. That's crazy. I'm going to avoid it as long as I can. I avoided the cell phone for 5 or 6 years, and I'm going to avoid that one too. We haven't even seen it yet, but I don't want to get in something like that. I'll be like Dr. McCoy on Star Trek. You're not beaming me into one of them cars.
What about 3D printing? When is that going to start to make a major impact on manufacturing?
I don't really know that much about it, to tell you the truth. I've never used a 3D printer or seen one with my own two eyes. I've only seen them talked about. For what I read, they're used in some factories, but you probably know more about it than I do.
Well, I can just imagine you can go and have your car printed for you at the local car dealership.
Yeah, that would be something, but I got to see it before I believe it. That's what I put it.
Do you think sometimes we put too much emphasis on high tech in the future, solving problems, like, say, working in a dangerous mine or something like that?
Yeah, I think so. I mean, technology's been a wonderful thing the past, since, the acceleration in technology has been amazing from a historical standpoint the past 200 years, but there hasn't been a technology yet that's changed everything, that's abolished the economics of the stock market or the economy or anything like that, and I don't think there ever will be one.
And taking a look at some other things you could invest in, how's the diamond business?
Oh, it's doing good. I mean, the diamond demand is there. It's not going away. And there's mining stocks you can invest in that do mine diamonds. The thing about them is they really trade more with the gold and silver stocks. So you kind of have to look at them as if that's what they are.
And of course, who knew that Canada would become a major diamond producer? Places like Flat, Saskatchewan, and the Yukon, where, they dig up gold, but who knew diamonds were there?
Yeah. I had, was there a boom going on in those towns?
Yes, there are. Diamonds are big. Canadian diamonds actually come with a little lasered polar bear on them. And apparently there are now counterfeits where people are now putting fake polar bears on because Canadian diamonds are very pure.
Okay.
Just like the hearts of our hockey players.
Yep, that's for sure. I'm not going to doubt that. I've seen them come down here and beat the team in North Carolina.
Yeah, well, of course, and even when the Hurricanes won, it was mostly Canadians, wasn't it?
Yeah, that's true.
Mike, anything else you wanted to add?
I think we pretty much covered what's going on. I mean, I know I'm sounding a little negative about the stock market, but I do think there's just times when, it pays off to just sit back, do less trading, not try to press things. We're in a correction, no matter what. Just let that play out and see where the market bottoms at. Corrections in a bull market, 10%, that's usually what they go to. And, if we go to 10% bottom, okay. But if not, then, the situation's really changed from what we've seen the past couple of years.
Mike, maybe remind people about your website.
Sure. It's, wallstreetwindow.com, and if they go there, got a fee, can opt in and get, free updates from me. And there's a whole bunch of educational videos and stuff too.
Mike, thanks again for being our guest.
Thank you.
Our guest has been Mike Swanson from wallstreetwindow.com. That wraps up our show for this week. Thanks to our guests Larry Reaugh and Mike Swanson, and thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.